In December 2024, accepted offers on prime London properties shot up by 34%. And then in January, they climbed another 12%.
Right. It really looked like a massive post-budget party if you just look at the transaction volumes.
Yeah, exactly.
Yeah.
Because, the pre-budget speculation was over and the new high-value council tax bans were actually announced at lower rates than people feared.
Right. So buyers just rushed back in to capitalize on that clarity.
Welcome to today's deep dive, everyone. We are looking at a February 2026 Knight Frank report that, well, it reveals a pretty glaring contradiction in those exact numbers.
Yeah, it's a fascinating paradox because while offers are surging, average prices in prime central London actually fell 5% in the year to January.
Wait, 5%. And outer London is basically flat, right?
Totally flat at negative 0.2%.
So today we are decoding why this apparent market recovery might actually be a very brief window of stability before things get much more complicated.
It really comes down to a stark imbalance in market entries. Like sales instructions spiked 15% above the 5-year average in January.
Wow, so just a massive injection of liquidity on the sell side.
Exactly. Sellers are finally pulling the trigger after holding off, but new prospective buyers actually dropped by 4%.
Oh, wow. So there is simply a shrinking pool of capital on the buy side to absorb all that inventory.
Right.
But why are buyers thinning out? I mean, what happened in the debt markets in mid-January? The Bank of England held their base rate at 3.75%, right?
Yeah, they held it, but borrowing costs for buyers spiked anyway. That's a crucial mechanism to understand. Mortgage rates aren't strictly pegged to the Bank of England's base rate.
They're priced off swap rates, right?
Spot on. Swap rates reflect the market's anticipation of future inflation and government borrowing.
Right, right.
So even with inflation inching toward that 2% target, bond markets got totally spooked in mid-January by broader fiscal uncertainties.
Which pushed up the cost of wholesale money and just instantly capped buyer spending power. So that naturally puts buyers in a holding pattern. If inflation is nearing 2%, the Bank of England could realistically cut rates in March.
Yeah, a March rate cut is highly plausible.
So a rational buyer is going to drag their feet until then to lock in a cheaper mortgage, right?
They are, but waiting for it ignores a much larger variable creeping into the risk models. The Knight Frank report really highlights that economic fundamentals are rapidly taking a backseat to the political calendar.
Right. And just to be clear to you listening, we are strictly impartial here. We are just reporting the pressures on Prime Minister Keir Starmer that the report mentions. We aren't taking any political sides.
Exactly. We're just looking at the market data. And Starmer is facing a convergence of immediate structural pressures.
Let's look at that timeline. We have the internal friction from the recent Peter Mandelson row.
Right, which signals potential cabinet-level instability to the markets.
And then there is the Gorton and Denton by-election coming up on February 26th, leading right into the local elections in May.
Yeah, and a poor showing in these localized races often emboldens party backbenchers to challenge leadership.
And if the market prices in a leadership challenge, the risk premium on UK debt increases, right?
Yes, a new leader, or even a weakened prime minister trying to consolidate power, historically turns to immediate fiscal stimulus.
Essentially spending their way out of a political deficit.
Exactly. We saw the exact mechanics of this play out during the recent Japanese elections.
Oh, right.
When the ruling coalition lost its majority, global bond markets immediately spiked Japanese government bond yields. They anticipated a flood of debt-fueled spending to appease voters.
So that translates directly back to London property. If the bond market demands higher yields because they fear a UK spending spree, swap rates go up.
Yep, and mortgage rates jump regardless of what the Bank of England decides to do in March.
Or, I suppose, a new administration could pivot the other way and revive wealth tax proposals to plug budget holes.
Both scenarios instantly erode the confidence that drove those December and January transaction spikes.
The current predictability we're seeing in the market is incredibly fragile.
It's a textbook example of why transaction volume alone is a lagging indicator of market health.
Yeah, the report bluntly suggests that by this summer, market participants might look back at this current window of stable pricing and clear policy with serious nostalgia.
I wouldn't be surprised at all.
Which forces a broader question for anyone managing a portfolio right now. We are trained to obsess over central bank meetings and inflation prints to predict property cycles.
Right, that's the standard playbook.
But is political volatility, the threat of internal party friction, sudden leadership shifts, and the resulting bond market panic, if that becomes the permanent primary driver of real estate values,
It changes everything.
It really does.
Yeah.
How does that fundamentally change the way you evaluate a long-term, illiquid investment in a major global city? Maybe the most important property metric isn't the interest rate anymore, but the political risk premium. Something for you to mull over. Thanks for joining us on this deep dive.